Meta just decoupled from a flat macro tape to rip nearly 9% in a single session, adding over $100 billion in market cap in a matter of hours. Retail is scrambling to figure out if Zuck's insane. AI cash burn is finally about to turn into a pure cash printing machine. Meta wrapped up the session, printing a massive 8.81% breakout. But the real headline driving institutional block orders isn't Facebook user metrics or ad inventory. It's a major structural pivot regarding how they deploy their infrastructure. For the last 18 months, the core bear thesis on Wall Street has been duration risk. The fear that Meta's massive capital expenditures into data centers and NVIDIA clusters would simply torch their operating margins before seeing a dime of return. Before we run the numbers on this cloud infrastructure play, smash that like button and subscribe. If you want to front-run institutional sector rotations and see exactly where smart money is positioning, hit the link in the description to join our private trading desk. Let's dive in. The game changed yesterday when reports dropped that Zuck is launching an internal initiative dubbed Meta Compute. Instead of letting their massive GPU inventory sit idle, Meta is evaluating a plan to lease out raw AI compute capacity and open up hosted model APIs to enterprise developers. This completely rewrites the monetization timeline. Meta isn't just a Capex black hole anymore. They are positioning to act as a primary hyperscaler, turning a massive structural cost center into a high-margin recurring revenue stream. If this multi-track model lands combining a model-as-a-service pipeline with bare metal infrastructure leasing, Meta moves from a pure social media stock to a direct threat against AWS, Microsoft Azure, and Google Cloud. But the immediate damage didn't hit the legacy hyperscalers. It triggered an absolute bloodbath across vertical AI neocloud providers. On the news, CoreWeave crashed over 13%, while Nebius and specialized AI infrastructure players saw massive institutional capital flight. The market logic here is dead simple. If a Tier 1 tech giant with massive economies of scale starts dumping its excess compute capacity onto the open market, it compresses spot pricing power and suffocates smaller infrastructure players who rely on Meta's growth. Concurrently, this triggered a sharp rotation inside the semiconductor space. Hardware names like Micron and semicap equipment stocks caught a heavy bid-side slowdown, as a sudden supply glut of leased compute raised fears that future chip procurement pipelines might start to decelerate. However, top analyst desks are arguing the exact opposite. If the Meta Compute cloud model successfully captures market share and validates its margins, it will actually force Zuck to accelerate his hardware layout, driving structural demand for next-gen HBM and advanced server architectures. Right now, the street remains heavily bullish, with institutional price targets tightly clustered between a conservative $700 floor and a highly aggressive $1,015 ceiling, yielding an average target of $822. The consensus view is clear. Any early monetization of their AI stack de-risks the long-term EPS trajectory. Make no mistake, though, execution risk is substantial. If enterprise onboarding stalls or if a broader ad market drawdown begins to squeeze overall corporate free cash flow, this massive Capex profile will quickly weigh heavy on GAAP earnings. Let's test your macro framework. If the big tech complex systematically begins leasing out excess AI compute, who walks away with the ultimate alpha? Is Meta the clear winner? Or do the legacy cloud giants maintain structural dominance? Drop your tactical thesis in the comments below. Smash the subscribe button and hit the notification bell if this institutional breakdown gave you an edge today. For our real-time entries, automated sector alerts, and private community flow tracking, check the links in the description. Catch you on the next tape.